In November 2024, the Bank of England reduced the base interest rate to 4.75%, which was welcome news for home buyers and first-time buyers, hoping this would be a continued trend in 2025 and that mortgage costs would come down. But the confusing thing is that fixed-rate mortgages have actually gone up instead of down. Why? In this video, I'll cover the key reasons why fixed-rate mortgages in the UK are going up right now, and we'll also cover the outlook for the rest of 2025. If you're new to this channel, I'm Matt. I've been a finance consultant for over 10 years. I now run my own company, and on this channel I talk all things personal finance. So let's start with what influences fixed rate mortgages in the UK. There are two key concepts to understand. The first is bond yields and the second is something called SONIA swap rates. And I'm going to explain both in a bit more detail now. The UK government generally spends more than they raise in tax, so they borrow money to fill the gap, usually by selling bonds to investors. UK government bonds are normally considered very safe, with little risk that the money will not be repaid, and they're mainly bought by financial institutions such as pension funds. The percentage return, known as the yield on government bonds, has been going up since around August 2024. Bond yields reflect the cost of UK government borrowing, and these have increased recently, with the yield on a 30-year bond hitting its highest level since 1998, while a 10-year bond rose to its highest level since 2008. Meaning it costs more for the government to borrow money over the long term. The rise in bond yields tends to lead to rising fixed mortgage rates because they're very responsive to changes in interest rate expectations. Bond yields influence the mortgage market through something called SONIA swap rates. SONIA stands for the Sterling Overnight Index Average, and swap rates are the rates that the banks will lend money to each other at and reflect lenders' expectations of future interest rates. They play a critical role in how fixed-rate mortgages are priced. When bond yields rise, swap rates tend to rise too, which increases the cost of funding for mortgage lenders, putting pressure on them to increase mortgage rates for home buyers who are refinancing and first-time buyers trying to get on the property ladder. As you can see from the graph, swap rates have been mostly trending upwards since mid-December 2024, which is bad news for borrowers as fixed-rate mortgages are likely to stay high, at least in the short term. So why are bond yields and swap rates rising? There are a few contributing factors to the increase. The first is that in the UK there are concerns about the economy underperforming, as it shrunk for 2 months in a row, and inflation remains stubborn, with the latest data showing the inflation rate at 2.5% in December 2024, which is above the Bank of England's 2% target. The second point is that the UK government budget that was announced in October last year had a big impact too, because of the likelihood of increased government spending, which has inflationary pressures. And as a result, the Bank of England might not be able to cut the base interest rate as quickly as they hoped. And the third point is the US election and global bond yield contagion. Almost everywhere right now, government bond yields are rising. In the US, Japan and Germany, we've seen bond yields climbing too. There is a great deal of uncertainty about what will happen when the President-elect Donald Trump returns to the White House this month. He has pledged to bring in tariffs on goods entering the US and to cut taxes, and investors worry that this will lead to inflation being more persistent than previously thought. So given all of this, what happens next to UK mortgage rates in 2025? According to Moneyfacts, the average rate on a 2-year fixed-rate mortgage is currently 5.47%, and the average 5-year fix is 5.25%. Although mortgage rates look set to remain volatile in the short term, Sarah Coles, who is the head of personal finance at Hargreaves Lansdown, commented that despite the bond market turmoil causing knock-on effects to mortgage rates, it hasn't particularly altered the expectations of what the Bank of England is likely to do next with interest rates. She said that the market is still pricing in just over a 60% chance of a rate cut next month in February. If this happens, then it will at least mean the cost of existing variable rate mortgages will go down. Most forecasters are now predicting that UK interest rates will come down more slowly through 2025 and over the next 3 to 4 years. If you're thinking about buying a home, it's generally better to consider how home ownership fits into your lifestyle and finances rather than trying to time the market to get the best mortgage rate. With mortgage rates looking like they will remain relatively high in the short term, the decision on whether to buy or to rent, or whether to pay off your mortgage early or invest, becomes increasingly important to consider. I've done videos to deep dive on these topics, so if you want to understand more, I'll leave the links to the videos down below. I hope this video has been helpful to explain and clear up some of the confusion about why fixed rate mortgages aren't falling following the Bank of England rate cuts. If there are any personal finance topics that you're interested in and would like to learn more about, then let me know in the comments below. I'd appreciate it if you subscribe to my channel, and I'll see you on the next video.